Welcome back to the Smart Money Blueprint. You've made it to chapter 2. Now we're going to talk about what you need to consider before you get started. My name's Adonis Lockett, and in this module, we're going to be debunking myths. So I got to tell you right now, it's always funny to hear the war stories and the philosophies and how new investors think hard money works based off of the stories that you see online, or people who've been doing the business for 20 years and 10 years ago it used to be like blah, blah, blah. No one cares. We're in this module, we're debunking all of those silly myths that you hear about, and we're going to tell you how exactly the industry is working. So the things that you heard may or may not be true. We're going to go Mythbuster styles and start exposing the lie. First, hard money lenders are the institutions and hedge funds. Private money lenders are individuals or small groups or family offices. The fact of the matter is that is actually false. As I mentioned in the previous modules in chapter 1, the terminology is changing. Institutions are now considered the private money lenders, and the individual who is giving you money is now the hard money lender. Now again, this is because the individual is going to make it a point to have the path of money being deployed easier than the institution, and as a byproduct, they're going to charge you a higher fee. So 10 years ago, the private money lender was actually the individual giving you money. The hard money lender was the company that was beating you in the head with all these fees and rates and all this other mumbo jumbo. Today, it is actually more infrequent to find the private individual who's the lender, but you'll also find in that scenario, the private individual is often more expensive in their origination, more expensive in their interest, but they may often have an easier way to get the money deployed. They may be able to forego appraisals. They may be able to get money pushed out in a few hours where most institutional lenders require a few days. So the terminology now is the institutions are the private money lenders, the individuals are the hard money lenders. Number 2, no credit check is required and you having bad credit is okay. This couldn't be more false if I wanted it to be. Not only is credit a big consideration, a lot of times it's one of the primary considerations for loan approval, leverage, interest rate, and origination. So the days of no credit check from the institution lenders are pretty much gone. Every blue moon, you'll find a private money lender that's okay. But I gotta tell you, to find a private money lender, individual or institution, that does not check your credit is very far and few in between. Now, for those of you who are private money lenders, you're loaning money out your 401k, you are the exception, not the rule. Everything I'm talking about when debunking these myths is the rule, not the exception. Number 3, the lender will not do a background check. Again, this is false. Not only will the lender, institution, and private individual check your credit, they also will check your background. Now check this out. Just because something does not show up on your credit does not mean it will not show up in your background check. So the private lending industry does have a way to check what you've done, whether it shows up on your credit report or not. So for those of you who know the banking system, right? I'm gonna give you a parallel. The banking system has this kind of back office communication network. If you have a bank with one of the regular bank, and you overdraft your account $1,000 and they close your account, the banking system will actually send that information to what's called check systems. And what check systems is pretty much a back channel line of communication between all the financial institutions to let the other institutions know if you've defrauded the bank, if you've had accounts closed and with an amount due to the bank. And what will happen is other banks will see that and say, hey, well, you had an account with insert bank name here that was overdrawn $1,000 and you never paid them, we don't want to open an account for you. So believe it or not, the banking system has a back channel line of communication that even though that doesn't show up on your credit report, they will know about it. The private lending sector is the exact same way. Everything that you've done that's attached to your social security number, your date of birth, your name, or in a combination of the two or three, the private lending channel knows about in your background report. So granted, a judgment of foreclosure, a felony or whatever may not show up on your credit, the private lending network knows it because when they pull your background, it tells them everything. So trust me when I tell you, if you think that you're gonna fly under the radar about something on your background that, oh, it doesn't show up on my credit report, so these people won't know about it, that is an absolutely false statement. The lender knows everything that you have done that has happened to you that is attached to your social security number. Number 4, no bank statements or reserves are required. To be honest with you, that's actually more true than it's not true. So this is one of those things that this boils down to the specific lender that you're working with. Half of the industry is okay not checking your bank statements. Half of the industry wants to see bank statements and reserves. So this is one of those things that I wouldn't necessarily call it a myth because that's more of a, it depends on who you talk to. But a lot of private money lenders don't really want to see your bank statements because they don't care. So because they don't source and season your money, and by source and season, I mean they don't check to see where a $10,000 deposit came from, who it came from, where it was from, blah, blah, blah. No one cares, right? Because at the end of the day, the private sector cares about at the time of closing, do you have the money or not? Now, even the ones that do require bank statements often do not care that you've had big chunks of money come in. They don't care where the money has come from. A lot of times they just want to know that you have it. So for the ones that don't require it, that is very true. A lot of lenders do not require you to provide bank statements, but the ones that do require you to provide bank statements, they really don't care where the money is coming from as long as you can provide a very top level description. Yeah, I sold a car, sold a house. Here's where I got this big deposit, and that usually will satisfy that requirement. Number 5, having real estate experience is not important. This is kind of true and false depending on what lender you speak to. And we're going to jump into the difference between local and national lenders later. But a lot of local lenders may not necessarily care about your experience because they are lending money local to the market. And if they have to take the property back, they know that they can move it to an investor in their network. Now, if you recall, I told you that there is a lot of times the lenders will be their biggest source of deals because they're doing a loan for someone in the local market who can perform. They pick up the phone, call you, you jump in, take over the deal. Same way when they fund the deal, if the deal goes left, they're about to be foreclosed on, they can call you and be like, hey, you want to take over this loan? I already got the loan in place. It avoids me to have a foreclosure. You get a new deal. You're like, yay, I love it. And then you jump in, take over the deal. Bada boom, bada bing. The local lender often does not care about experience because they know the market. Now, you'll find that the big institutional nationwide lenders are the ones that are really going to harp on experience because they want to make sure that if they're loaning money to you, that you know how to get in and out of the project. And if you don't have experience, they're going to want you to put more money down so you're more vested into the deal, so you're less likely to walk away. So you want to understand what your local and national lenders are doing so you can do a side-by-side comparison of which lender best accommodates your investment strategy. Number 6. The process is simple and should only take 2 to 3 days to close. Getting a loan is simple and we should be able to close in 2 or 3 days because you're only a hard money lender. I want to stress in the most sincerest version possible, the fuck out of here applies in the most hardcore absolute value for this particular topic. That is the most displaced, misplaced, I'm giving all of you the words that don't even make sense, but that is the most inaccurate statement. The process not often is not only simple, it can be extended, it can be frustrating, it can be over-inundating because the myth is getting a hard money loan is slap a name on paper and an address, give me money. That is false. That is how it used to be 10, 15, 20 years ago. Today, even the private individuals require a pretty decent underwrite. Loan applications, IDs, entity docs. Most lenders won't even let you close in your personal name. You have to close in an entity. So if you don't have an entity, you got to establish an entity and provide all the entity docs, operating agreements, registrations, articles of organization, certificate of formations. I mean, literally the whole kit and caboodle. So there's so much documentation that goes into getting a loan approved that when you Google and you go back and talk about how it used to be 10 years ago, most borrowers who are new, most lenders who are on the consumer side of the business are blown away about how extensive the underwriting is for a private money loan, to the point where they're almost offended about how much research goes into underwriting a borrower for a private money loan. Consumer agents, consumer lenders, borrowers who are new, stop telling yourself this is a no doc, simple 2-day process, because you are wrong. Myth number 7. Whew, y'all got me hot talking about that one. Myth number 7. Private and hard money loans are really high interest rates and huge fees. Yeah, that's relative, right? Compared to conventional loans, absolutely. Compared to private money and hard money loans 10 years ago, that's a false statement. Compared to the local versus the national lender, you'll find that most national lenders that are backed by institutions or hedge funds are actually sitting on a ton of capital. And it's to the point now where the money is not making money by not being deployed or put out on the street or being loaned to you. So the interest rates are dropping, the origination fees are dropping, all the fees are dropping just so they can get their money out working for them. So in the last maybe 4 or 5 years, you'll find that interest rates from hard money loans went from the standard being 14 to 16%. Now, at some point, the standard was 7 or 8%. Like, the interest rates have cut in half just to get the money out on the street, because the market is flooded with money and these lenders need to get it out on the street. So they keep chipping away at the rate, at the origination fee, just to get their money out working for them. So hard money now, yes. Is it high relative to conventional loans? Absolutely. Is it high relative to what the industry was doing 10 years ago? Absolutely not. So this is a true and false myth. Number 8, you can use hard money for your primary residence. Now, I thought that I couldn't be more hardcore about a statement being false as I was in the previous myth, but this one is the epitome of what is not a private money or hard money loans. Hard money loans are not for your primary residence. This is a true myth. Hard money loans and private money loans are specifically for investment properties, and there is often zero budge on that. So no, a private money or hard money loan is not used for your primary residence. Myth number 9, you can finance any deal, bad or terrible, with hard money because it's hard money. Again, that is a very inaccurate statement. Not only does the lender evaluate the deal to make sure that it makes sense, the lender will actually decline a deal if the numbers from a flip don't make sense and you do not have a proper exit strategy. Now, it's subjective for someone to say whether a deal is a good deal or not. A terrible flip deal could be a phenomenal rental. A terrible rental can be a phenomenal flip, vice versa. And there are other different strategies that investors use, like subject to, like wraps, all that good stuff. So a lot of times what the lender will do is look at one thing. First of all, as a flip, does it make sense? They'll come back to you and say, hey, the numbers don't make sense as a flip, you'll end up losing money. To which, if you provide a reasonable exit strategy, well, this is you, of course. Well, I don't want to flip, I want to keep a rental. Then the lender's like, oh, okay. So now they just want to make sure you have a way to exit their loan so they get their money back. And as long as you can present a make sense situation, the lender will often give you the loan as long as they are confident and comfortable with your exit strategy. Myth number 10, you can get a private hard money loan in your personal name. Now, I will say for the most part, this is not true, but a lot of local lenders and even some of the national lenders are okay with you getting a loan in your personal name. Now, the reason why a lot of lenders don't want you to get a loan in your personal name, because if you rear end someone, now the property that they loan on is attached to you personally, which means that a lawsuit about you bumping someone and rear-ending someone actually now makes their asset or the property that they have a loan against susceptible to a lawsuit. So a lot of times, most lenders want you to do a loan in your business name to insulate their investment in a property. But sometimes you will find that some lenders are actually okay doing a loan in your personal name based off of their internal underwriting criteria. Myth number 11, if you don't think a document is necessary, you don't have to provide it. That myth was so shockingly stupid that it literally shook the whole room. False. Aggressively false. Unequivocally false. Like STFU false. No. Just because you don't understand why a document needs to be provided, or just because you think the document is not important, does not mean it needs to be provided. And I gotta tell you, now I'm talking specifically to you consumer loan officers that will call the hard money lender and say, well, why do you need that? You only need that for consumer loans. Hard money loans don't need that. Shut up. We need it. And the bottom line is that if a lender asks for it, don't argue. We need it. No matter how mad you get, how dismissive you become, the bottom line is the lender needs the documents they request. Otherwise, they wouldn't request it. Simple, right? You'd think so, but let's move on. Myth number 12, you do not need an appraisal. Now, a year ago, I'd have been hardcore, like, this is crazy. But ironically, there's a lot of local lenders don't require an appraisal, but now even some of the larger national lenders are okay with desktop reviews based on the way the economy is shifting. Now, you'll find that a lot of lenders that are okay with desktop reviews that don't require appraisal are usually ones that have a, wait for it, relationship with the investor, and they know that the investor can perform. I'll tell you, me personally, I had to do about 20 loans with one of the national lenders before they were okay doing a desktop review for them to feel comfortable taking my word and theirs just off a desktop review as gospel for the value. Most lenders that don't require appraisals are usually have a way to check values in the local market. There are some lenders that will actually make an exception on a desktop review based on your relationship. So I'm going to say that that myth is true and false depending on the lender that you're talking to. Myth number 13, you cannot create an entity for a single transaction. I don't know why that's even, why is this even on here? Like, that is the, of course, no does situation. Yes, you can create an entity for a single transaction. And not only can you create a single entity for the transaction, you can create it a day or two before closing. There's no title or age of the entity requirement. And a lot of times, some lenders will actually make you create an entity specific for this particular or that particular transaction to make sure that you don't have a bunch of assets in an entity that is susceptible to lawsuits for stuff that doesn't involve them. So to answer your question, yes, you can create an entity for a single transaction. Some lenders actually mandate it, and most lenders, I'll even go as far as to say, all lenders don't even care that the entity was created a week before closing. Myth number 14, your funds must be documented, sourced, and seasoned. Now, for the private sector, I'm going to say that is false. You do not have to document where your money comes from. Now, you do often, for the lenders that require bank statements, you do have to show that the down payment and reserves are there, but 95% of the lenders, both local and national, don't care where the money comes from as long as the money is there leading up to the day of the transaction. Myth number 15, if you request a draw, you should get every dollar you request. Whew. Boy, I tell you, this is a painful. That is actually false. Just because you request a draw, and we're gonna get into there's a whole module that talks about the draw process that we're gonna get into later. But just because you request a draw, the lender does not care about what you request. They care about what has been completed at the time the inspection happens. So the way the draws work, hey, you tell the lender you need $20,000 to do 4 things: paint, floors, roof, and foundation. If they come out and inspect and you request 50% of the draw, but only one thing has been done, they're only going to give you the monies for that one thing. And it doesn't matter if you're overextended, doesn't matter if the prices went up, none of that matters. The lender only cares, I'm going to give you the money for your draw based on what's been completed. So it is a myth to think that just because you request a draw for X dollars means you'll actually get X dollars. Myth number 16, you have to be a US citizen to get a private money loan. For most lenders, this is true and false. This is specifically for the lender that you work with. Some lenders are okay lending to foreign nationals. Some lenders do not want to lend to foreign nationals at all. The ones that are okay lending to foreign nationals, they typically want to see that the foreign national has a bank account in the US, that maybe they've done real estate in the US, or that they have some tie to the US, whether it be an I-10 number or something to that effect. So even the ones that don't have those requirements will usually result in lower leverages, lower LTVs, higher interest rate, higher fees. So there are some lenders that are A-okay lending to foreign nationals, but you can definitely expect a difference in the terms when lending to a foreign national. Myth number 17, you can get a hard money loan for an out-of-country transaction. That's mostly false. Most lenders will not lend outside of the US just because it is difficult for them to keep abreast with all of the government regulations. And in some countries, the government can walk in, take possession of your property, and there's nothing you can do about it. So what you'll find that most private money lenders want to keep their money in the US where they understand how the local government operates. Myth number 18, private and hard money loans are only for short-term fix and flip or bridge deals. Now, 5 years ago, I would agree that is a true statement, but nowadays, the private sector has actually extended a landlord program because 6-7 years ago, the private lending industry realized that it was losing trillions of dollars and not offering loans to investors who wanted to build rental portfolios. So the private sector created a long-term rental loan that allowed investors without DTI and tax returns and everything, the people who are full-time investors, to get into a 30-year fixed interest rate loan with a very competitive interest rate. So that is actually false. The private sector does offer long-term loans, and not only do they offer 30-year fixed loans, they actually have really competitive interest rates. Myth number 19, bankruptcies, foreclosures, tax liens do not matter to a private money lender. That is false. Private money lenders still care about how you perform in your financial capacity. And believe it or not, they actually have very similar requirements regarding bankruptcies, foreclosures, and tax liens that a regular conventional loan will have. For example, a lot of private lenders want to see that a bankruptcy has been removed 2 years before they'll give you a loan. Foreclosure, 2 to 3 years. Tax lien, they want to actually see that a payment plan is in place for a tax lien before they extend the loan. So the private sector is actually pretty hardcore about making sure that your bankruptcies, foreclosures, tax liens, judgments, all of these things are actually have a repayment plan in place, or there's some separation from the time the incident actually occurred before they will extend you a loan. Myth number 20. Having a recurring or long-standing relationship with your lender is not important. This is one of those myths that shake the room. That is false. Let me explain very clearly. If the only thing you care about is getting the cheapest interest rate or the lowest interest rate, the cheapest origination fee, or the highest leverage, you are setting yourself up for failure. And I know I make jokes and all these little things, but I want to be very straight with you and telling you, if the only thing that is of interest to you is always getting the bottom dollar, and you will shop to get that and never establish a relationship, you will find that you are stunting your growth in your business, because by the time you make it to the deal where you really need a favor called in, you've only done the deal with one lender. You've shopped 5 lenders, haven't closed with half of them. So when you ask them for a favor, their response is, I don't know you. Why would I go out and extend myself for you when the only thing you've done is shop me and always try to squeeze me for a 0.5%? And every time someone beats me with a 1/4 point here or a fraction of a percent there, you roll out. So no, I don't want to do any favors for you because we don't have that type of relationship. And if you think that I'm lying, think about this. Imagine if a stranger walks up to you and says, loan me $50. Your natural reaction is, I don't know you. Why would I give you $50? Now, take that same situation and insert your best friend, your homie, auntie, uncle. Now, assuming that your auntie, uncle pays their bills and all that stuff. A best friend that you know is good for it, you'll give that best friend $50 because you know that they'll pay you back. If you can understand that concept, then you understand the power of relationships in the private lending business. Whew, we just covered 20 myths. To recap, just watch the module again. I can't recap all 20 of them, but please pay attention to the things that I said, because the more you can actually dial into what's actually happening in the private lending space, the more successful you will be in securing and scaling your private investing, your real estate investing business. As always, you guys have been great. My name is Adonis Lockett. If you're watching our YouTube channel, make sure to subscribe, click the like button, find me on social media, Facebook and Instagram at Adonis Lockett. I appreciate you joining me, and I will see you next module.